You are listening to Investing Matters, brought to you in association with London South East. This is the show that provides informative, educational and entertaining content from the world of investing. We do not give advice, so please do your own research.
Hello and welcome to the Investing Matters podcast. My name is Peter Higgins and you can find me at Conkers3 on Twitter. And today I have the privilege of speaking with Charlie Huggins, Head of Equities at Wealth Club, the award-winning tax-efficient investment service. Charlie is also the manager of the recently launched Wealth Club discretionary share portfolio. Hello, Charlie, and thank you for joining me today.
Hi, Peter.
Charlie, I want to start our interview, if I may, with the fact that you were born and schooled in Sheffield, South Yorkshire, and both your parents worked in the steel industry. What did you learn from your tenacious parents, given you were and around the declining steel industry of Sheffield?
Yeah, well, it wasn't an easy industry to be in. So my dad in particular worked very long hours for not great reward. You know, every year it seemed to be that more and more people were laid off in his businesses that he worked for. So probably the main thing I learned from that is try not to work in a declining industry. But he worked in the steel industry all his career. He was made redundant at the age of 55 and then moved to another steel tool industry and lasted about 10 years in that, and then eventually they made him redundant, but he could then retire. So it was a difficult choice of career, I would say. So that was probably the main thing I learned, is try not to work for or invest in declining industries if you can avoid it. And if you do, the value of hard work, because he just had to work harder than everyone else to make sure that he was always the last person standing at the end.
Brilliant. I love that reply. And as is the ethos of most people that I know that are up north, Lancashire and Yorkshire. So that's very true. Tenacious and hardworking. Now, Charlie, you did extremely well academically. And as a lad from Sheffield, you went on to Oxford University 2007, studying Masters in Biochemistry. And you graduated with a first in 2011. Your parents must have been immensely proud and still proud of that academic achievement that you attained at Oxford.
Yeah, it wasn't that common for. I think there was one other person from my school that went to Oxford. It's quite a big school, but yeah, it was a very different environment, Oxford, to what I've been brought up in Sheffield. Going to state schools in Sheffield, it was slightly different environment, but shall we say? So it took a bit of adapting to.
And what did you learn from that time there at uni?
Well, I mean, I learned, as I said, going from one extreme to the other, really, from what I've been brought up to, then going to Oxford, which is such a unusual place. Also, having done a degree biochemistry, which in hindsight probably didn't enjoy very much. I think the reason I chose it was because I was reasonably good at biology and chemistry. It seemed like the right thing to do. It seemed like it would open up career opportunities for me. It would look good on the CV, that kind of stuff. I think as you get older, you realize that actually that stuff isn't all that important, and it's much more important to do what you're passionate and interested in, because that's the thing that ultimately sustains you. I couldn't do any more than 4 years at Oxford. That was my absolute limit, to do biochemistry. And I thought, what can I go on and do that truly interests me and inspires me? And that was why I ended up going into investing and finance. I suppose probably quite a lot of people go into investing and finance thinking, it'll be a great job and great money or whatever. But for me, it was purely about, this is what I think, this is the career that I want to pursue. This is what truly interests me. So it was a 360 switch, or 180 switch or whatever, from doing biochemistry to finance.
Yeah, I was going to touch on that because that's the twist I was going to ask you about. You qualified in biochemistry, but then you always had this keen interest in finance and investing. And I wanted to ask you where that started from. How young were you?
I probably bought my first share when I was in my late teens. I think my mum was a Standard Life policy holder. She had some Standard Life shares, and I ended up buying them off her. So I suppose in theory I didn't actually own them. She still owned them, but I gave her money and I, in effect, owned them from that point on. Um, so I started early. I also invested in quite a big part of my student loan into the stock market in 2007-8, up to 2008-9, which obviously we know how that ended. That didn't end too well. In terms of where it came from, I genuinely have no idea. My parents were not at all interested in finance or investing. Obviously, knew nothing about it. Like many people in this country, I suppose financial education wasn't it was never really been taught in schools or anything, so they didn't know much about it. My granddad did used to invest a little bit, so I learned a little bit from him, but I think it was just something I was born with.
Yeah, thank you for that reply. Did the events of the financial crisis and the crash and those investments that you made with your student loan, did they have any impact on your thinking about actually I'd like to go into that industry at some point in the future?
I mean, I suppose it probably should have put me off, really, because it's not all, it was literally, I think I invested a few months before it crashed, and it was, anyone who remembers that time, 08, 09, lines of queues outside Northern Rock. Every time you turn the 9 o'clock news, 10 o'clock news on, it was stories about more troubles at banks or more, economy. The news was just awful around that time, and the stock market was awful. So it probably should have put me off. It didn't. If anything, it probably made me even more fascinated by it. But I think it probably did instill a sense of caution in me that's probably never left me, because I think those early experiences inevitably do impact you. So I think that probably has had some impact on my investment approach ever since. It's hard to say, isn't it? You never quite know. But one thing it didn't do, thankfully, was put me off.
Brilliant. Thank you for that reply. Now, Charlie, you joined Hargreaves Lansdown in 2011, sorry, straight from
Yeah.
the university. And you joined us on a graduate scheme. Please, can you share with us how that came about and what it entailed, that scheme that you were on?
That was I was coming towards the end of my time at Oxford. Obviously, as I said, knew that I wanted a job in finance. I knew a lot about Hargreaves Lansdown, having interacted with them. My granddad was a client of theirs, so I knew quite a lot about Hargreaves Lansdown. I looked at them and I thought this is a tremendous business, and everything it does, I'm interested in terms of investing, ISAs, pensions. So I just sent a purely speculative application to them, um, and didn't hear anything. So I sent them another speculative application and didn't hear anything. And then I think on the third time, it ended in the lap of Alex Davies, who was director of pensions at that time. He then later left to set up Wealth Club, which is who I'm now working for. But they created a graduate scheme for me, luckily. So I was the only one on that scheme initially. They've since expanded it quite significantly. But that just gave me the opportunity to rotate around the business and to learn all about different parts of Hargreaves Lansdown's business. So that was it was a good foundation into a good learning opportunity, just to have exposure to so many different parts of what was a tremendously run business with Peter Hargreaves, the founder, was still there at that time, and it was just a very slick operation.
Brilliant. Now, you joined a research team initially, working as a fund research analyst, Charlie. What were you researching? Who were you meeting? And what were your greatest lessons from that time?
Yeah, so soon after the graduate rotation scheme, I moved into the research department, which was my main area of interest. Initially, as a fund research analyst, as you say, that just gave me the opportunity to meet lots of fund managers, to study their track records, to get inside their brains, to see how they thought, to see what mistakes they made, to see what worked and what didn't really. And obviously, meeting so many different fund managers gave me exposure to lots of different styles of how people did it, and so that was quite interesting. Hargreaves Lansdown was at that time, and probably still is, best known for its fund research. So I was joining a team that was very well set up to research funds. As time went on, I would also do more on the shares. I would research shares, start writing more about shares. So the role did evolve. But yeah, it was just getting that insight into how the fund management industry worked really was the biggest lesson.
Great, thank you for that reply. Now, Harveys Lansdown clearly nurtured your talents because you were quite young, if I may say so, and you helped to establish and run the HL Select funds, and you were managing money at quite a young age.
Yeah, so so Hargreaves Lansdown had run multi-manager funds in the past, but it had never run a direct equity fund that invested into shares rather than funds. So because of my interest in shares, probably more luck than anything, there was no one really else in the business that wanted to do that or that was positioned to do that. So at a very young age, I was given the chance to launch and establish the HL Select funds, which launched around December 2016, Select UK Growth, and then after that a UK Income Fund. So yeah, I think I was about 27 when I started managing those funds. Did that for about 5 years before joining Wealth Club. So yes, that was it was great to be given that opportunity to run money at such an early age. I learned a tremendous amount, made lots of mistakes. So yeah.
But you also had a great performance during that 5-year tenure or so when you were running it as well.
Yeah, the performance was reasonable. It's always difficult to say, isn't it, with hindsight, how much of that is luck and how much is judgment. Probably a combination of the two. I would deem 5 years as a very short track record, really, in the context of my investment style is sort of very, very long term. So I think you always need to be careful about taking too many lessons from a short track record. But yes, it was reasonably good. But most of all, it was just having the opportunity to run money for other people and all there's no substitute for that. I was running my own money. I have been for many years, as I said, since my late teens. But when you're running money for other people, that's when you really learn that it feels different. It's one thing losing money for yourself; it's another losing money for other people.
Yeah, and you also had to overcome the hurdles of what was the COVID period as well. Lots of uncertainty, volatility in markets, and you navigated that really quite assured as well.
Well, that was a very interesting time. I mean, it's easy to look back now and say, COVID, yes, vaccines are going to come along, and yes, we're all going to get out and about again, and economies are going to open up. But at the time, that was far from assured. We didn't even know whether we would have vaccines. We didn't even know whether people would be allowed out of their homes. And revenues for a lot of businesses just disappeared overnight. And obviously, government stepped in and helped out businesses, which was thank God they did. But at the time, that was far from obvious. So yeah, that was an interesting time, definitely.
Brilliant. Now, given how successful you'd been at Hargreaves Lansdown, what was the driver after 10 years to leave?
It was mainly just a new opportunity that came up at Wealth Club. So, as I said, the founder of Wealth Club, Alex Davies, I had worked with in the past. We'd kept in touch. He was he was keen for me to go and launch a portfolio for him. Because I was at Hargreaves Lansdown already running money, I was, putting him off quite a lot and saying, "Look, I'm still happy at Hargreaves Lansdown, still trying to get a track record." But eventually, he managed to persuade me. But I think by that time, by the end of the 5 years, I was ready for a new challenge. I could have continued to work at Hargreaves Lansdown, continued to take salary and bonus and what have you, and accumulated money. Instead, I thought no, I think I'll learn more by launching a portfolio for myself. And I think in this industry, in this career, is you just have to keep on learning, keep on learning, keep on learning. I'm sure I would have kept on learning at Hargreaves Lansdown, but I felt that this was an opportunity to learn even more and to launch a portfolio that I could really call my own, and that I could manage in a way that was exactly how I would run my own money. So that was the idea behind it.
Brilliant. We're going to talk a bit more about your portfolio a bit later. Yeah, you joined the Wealth Club in April 2022. Please can you share with us an overview of the Wealth Club, its investment philosophy, and its methodology for evaluating the best long-term investments, and who you are your preferred client group?
Yeah, so Wealth Club has been a leader really in tax efficient investing, VCTs, EIS. So that was what the business was established on, tax efficient investing, and it's done a very good job in that area. As a lot of the other platforms have curtailed their activities in those areas, Wealth Club has gone off after that niche very successfully. So anyone looking for tax efficient investments would come to Wealth Club, and there's no better place for that. As time has gone on and the business has grown, and it's still a small business but highly profitable. As a business has grown, it has great ambition, and it now wants to expand into offering more mainstream investments. And that was where the idea of offering the Quality Shares portfolio came along, to offer a portfolio of great businesses, 15 to 20 businesses selected from across the globe, a very high conviction portfolio, and not just a tax saving vehicle, but this is hopefully a portfolio that people can own for the long term and to grow their long-term wealth.
Brilliant, thank you for that. Now, you launched, as you say, the Quality Shares portfolio in March 2023. Please can you share with us the key elements you look for in a company for it to be included in your portfolio, Charlie?
Yeah, so the portfolio has very, very few restrictions. So this is a global portfolio. It can go in any developed market. There's no real size restrictions. So this is very much a best ideas portfolio. And what I wanted to create was a portfolio of exceptional businesses. First and foremost, the best possible businesses I could find. That was what I was looking for. So how do I define that? It's a few things. I have to understand the business. So there's many businesses, and I've learned more and more as I've gone on, that are very difficult to understand. Warren Buffett talks about a circle of competence, and he says, you must stay within your circle of competence. And as time's gone on, I've probably learned that my circle of competence is smaller and smaller than I initially thought it was. So most businesses are excluded on the basis of me not being able to understand them, or just having complex business model, complex accounting. If I understand it, what I'm looking for then is first and foremost resilience. Great businesses endure over time. They adapt. They are able to survive periods of crisis, because the one thing you can guarantee is that we'll get a crisis. I've seen in my relatively short time the financial crisis and the COVID pandemic, and I'm sure that there'll be another crisis in the next few years. It's just inevitable. You need to find businesses that can survive a crisis. That means having loyal customers, often recurring revenue, very strong balance sheet, and a business model that is durable. In addition to that, I'm looking for a very strong competitive moat. It's not lack of growth opportunities that destroys businesses, it's competition. If you can find a business that is as immune as possible from competitive factors, then it will be much more likely to endure, and it will be much more resilient. That can come from brands or distribution networks. There are many things that play into the moat of a business, but that is a key thing I'm looking for. Once I found a business model that is resilient and relatively immune to competition, the management and culture are critical, because the culture within a business dictates how decisions are made. It dictates what kind of people end up working for a business. It dictates what kind of people are retained within a business. It dictates the talent within a business. It dictates almost everything, the culture, and it's something that few investors pay enough attention to, in my view. But if you get the management and culture of business right, everything else tends to look after itself. And then the final thing is cash generation. You can have all of that and still not generate very much cash. And profit and cash are not the same thing. Some businesses are quite good at, well, we've seen a lot of businesses very good at generating revenue, not very good at generating profit, and even worse at generating cash. I'm looking for businesses that prioritize cash. They're not reliant on factories, machineries, heavy machinery. They tend to be more reliant on the brains of their employees than they are on physical assets. And they just generate tons of cash in good times and bad. So that combination of factors is what I'm looking for. And then I have a 60-point investment checklist that I assess all these factors through, which helps me to make sure I'm not overlooking anything and keeps me on the straight and narrow, hopefully.
Brilliant. I love the fact that you've got a 60-point checklist. That seems huge to me, but I think it's very important that you probably expand on why that's so important, because there's going to be supposedly a large, a 10,000 stocks globally, probably that could be assessed, but you're trying to find 15, if not 20. So where do most supposed quality stocks fail your benchmark, Charlie, to be included?
Where do most of them fail? It's probably the competition piece, actually. You've got to, if you're investing in a quality business, you've got to be as sure as possible that it's still going to be thriving 10 years from now, 10 or 20 years from now. And we've seen many businesses fall by the wayside, many tech businesses in particular. Now, normally that's either competition. Think of, Blockbuster and Netflix. Netflix coming along and Blockbuster not reacting to that. And so that's competition, but also technological change. So I would say the majority of businesses are either doing something that is relatively easy for the competition to replicate, and or are in an area which you think changing technology or changing trends could disrupt that business. So they're probably the two biggest reasons, but it could be I don't like the culture. It could be that, as I said, that I don't understand it. Maybe it's a great business, but I just don't understand it well enough. Look at all the problems that investors in banks have had, because who understands banks? I mean, I don't. Most banks are incredible. If you try going through their accounts, or insurers, incredibly difficult to understand. So yeah, they're probably the main two, but they can fail for all number of reasons. Balance sheet sometimes you think this is a great business, but why has it got so much debt, or why have they structured the balance sheet in that way? Sometimes it's just, I don't like overly cyclical businesses generally. I do make some exceptions, but I don't want a business that as soon as the economy turns down, it's going to start making losses or whatever. There's quite a lot of businesses like that. The cash, a business can fall down. As I said, not that many businesses excel at generating cash. So it can be all manner of reasons. And that's the point of the checklist, is to go through each one and say, well, what do I really think about this? Because it's very easy to sell yourself a narrative. Human beings, we love narratives, we love stories. And the checklist forces you to say, well, the narrative may be great, but on this point, it fails. And no business will ever tick every box. It's just, I don't know any business that's ticked every 60 boxes, but it's just, you want as many ticks as possible.
Brilliant. Love that response. Thank you ever so much for that clarity as well, Charlie. Appreciate it. You place a great deal of importance, Charlie, regarding your quality companies having growing and strong free cash flow. For the inexperienced investor, please can you just expand on why that's so vital?
Yeah, so free cash flow is the cash that's left over at a business after it's paid its bills, basically, after it's paid any capital expenditures that it needs to make, after it's paid its employees, after it's paid taxes, interest on debts, whatever. So the cash is, think of it of what's in the till at the end of the day or at the end of the year. And that cash gives a business so many options. So business that generates lots of free cash flow can then go out and it could acquire other businesses. It can pay off debts. It can expand its existing business, or it can return that cash to shareholders. All of those are good options for, if done sensibly, are good options for shareholders. The worst type of businesses to own are the ones where it runs really hard to stand still. It has to invest loads in, new manufacturing facilities or new oil wells or whatever, and then you get to the end of the year and all the cash is gone. I want to see a business at the end of the year that generates as much cash as possible. Ultimately, that is how you value a business as well, is on cash flow. You've probably heard of discounted cash flow models and all of that. The value of a business depends on how much cash it generates, free cash it generates between now and Judgment Day, which is when the business ceases to exist. That is how you value a business. So really, the only thing you should care about as an investor is the cash. Nothing else really matters. Revenue doesn't matter, profit doesn't matter, because profit is just an accounting term. It's the cold, hard cash that comes into a business, because at the end of the day, cash is what pays bills. Profit doesn't pay bills, revenue doesn't pay bills, cash pays bills, and cash is what allows a business to expand and to reward its shareholders with dividends, share buybacks, etc.
Brilliant reply. Thank you ever so much. Now, given your forensically detailed research, analysis, and filtering process of your checklist, please can you provide and share with us 3 distinctly different companies that you've already selected for your portfolio, please?
3 company examples. Well, one which I've talked about quite a lot is Diploma. It's listed in the UK, around about 3 billion market capitalization. It's an industrial distributor of industrial components such as seals. So they go into things like heavy mobile machinery. So if you look on a local construction site, you see a big piece of Caterpillar equipment. Seals, that piece of equipment will contain lots of seals, which basically it's hard to describe to somebody who doesn't work in that industry, but they are critical for that machinery to operate. And if they often break, and people who own that machinery need a replacement seal quickly, Diploma has a large group of suppliers which you can go to and can get any seal that you want and can supply it to you the next day. That's not all it does. It provides lots of critical components that go into mainly industrial and medical appliances. Why do I like it? Well, it's hard to see that business going out of fashion. It's hard to see any technology that comes along to disrupt it. It's extremely cash generative because it doesn't make these products itself. It's just a distributor. So it doesn't need big manufacturing facilities or factories. And added to that, it has an excellent culture, in my view, decentralized culture, which means that it contains lots of different individual operating businesses, all with their own owner-operator running them, with their own profit and loss account. So very accountable, very agile, very entrepreneurial. It's made some very good acquisitions, and it's operating in growing markets, and it's got the ability to do acquisitions to supplement that. So it has good growth prospects, in my view, and it's a resilient business. On the other end of the scale, something like RELX, which does academic journals. It provides data and tools to scientists, to lawyers, to financial institutions for doing fraud checks and know your customer checks. The data and the tools that RELX provides to its customers are critical. They tend to be required in good times and bad, because doing fraud checks, for example, or accessing medical research is something that you need no matter what. Very high recurring revenue, very highly cash generative, and again, sensibly managed. It's not a business that tends to make the headlines. It's not a business that many people have even heard of or come across. But if you're a lawyer, if you're a scientist, or if you work in finance, or even many other industries, you may rely on them every day. Or insurers use RELX data for writing quotes, for example. So it's absolutely critical. So that's another example of a business that I like. And another one, Danaher is a life sciences business. It provides equipment to biotechnology and pharmaceutical companies. It provides diagnostic equipment. The thing I like about them is that they're sort of a picks and shovels provider to that industry. So the trouble with investing in a biotechnology or pharmaceutical business is you're always reliant on the next drug. You know, what's the next big drug that's going to come out? And now there's loads of new therapies in development at the moment, and they're tremendously exciting, opening up the potential for treating diabetes, Alzheimer's, lots of different diseases which we've never really been able to treat well before. But trying to pick a winner amongst the individual companies is very difficult, and you've got the risk of drug development, whereas Danaher is providing equipment to those companies. So whoever wins, they should benefit as long as these new therapies get launched. So again, it's maybe not the most exciting way to play the theme, but it's a more resilient way, because I like businesses where heads I win, tails I don't lose very much, and that they've got lots of shots on goal. I dislike businesses that are heavily reliant on a single customer, a single drug, a single thing happening. So AI is another great example of, RELX has been incorporating AI into its data and solutions for many years. I'm not going to go invest in a new AI company that might do well if AI takes off. I want somebody who's applying it more broadly. So there are three examples that I would give.
Thank you so much for that. And you covered my second phase of my question, which is going to cover RELX being an under the radar AI company. So thank you for that. Now, Charlie, we spoke already a little bit about some stocks that haven't made the grade. Please, can you share with us two popular high quality names which have not yet met your criteria to be within your quality shares portfolio?
Unilever's quite a good example. It's a good business. It has some very good brands. It's very resilient. It stood the test of time. It does generate a lot of cash. But the culture of that business hasn't been right, in my view, over the last decade, or at least the last decade. I think it's quite bureaucratic. I think they own too many brands. I think the management has been too focused on acquisition, and not focused enough on disposals. Return on capital has been declining for several years. So that's an example of a business where actually I quite like the business, but the management and culture is not. It fails the checklist mainly on the management and culture piece. They do have new management coming in, so that could change. I'll monitor that one. So that one fails. I suppose another popular business would be Amazon. Is not one that I'm considering owning. It's very capital intensive. It's having to spend a lot of money on, or it has spent a lot of money on new warehouses, for example. So during the pandemic, obviously at the time, everyone thought this is great for Amazon because everyone's shopping online all of a sudden, and Amazon's one of the few places they can get goods. But Amazon had to invest a lot of money in order to meet that demand, and the returns that it makes on its investments, not just in warehousing, but in lots of different areas that the company is investing in, I think is hard for me to appraise. I prefer businesses where every pound or dollar that they spend, I can say with some confidence that will generate a very good return for me as a shareholder, and I'm not sure you can say that about Amazon. It's also just a very complicated business, and Amazon needs to stay on top of changing trends, and it has done phenomenally. I'm not, I think Amazon's a tremendous business. I'm not saying that it isn't, but it's a business that always needs to stay one step ahead. And again, I prefer businesses that don't have to always be at the forefront of change, because that's hard to do. And obviously Jeff Bezos has been phenomenal leading that business. I know now he's stepped back, but you compare Amazon to, say, a Microsoft. Few people would say Microsoft is a true cutting edge innovator. It's tended to always be there, and it's tended to use its existing customer relationships and distribution to that's bought it time to adapt to new trends. So I prefer a business like Microsoft to an Amazon for that reason. It comes back to resilience. It's resilience again.
Yeah. Thank you. I love the examples you've given there as well. I really appreciate it. Now, Charlie, given your long-term investment plan and the fact that you seek to do little or no trading bar rebalancing, which sort of negative company issues could trigger an instant sell for you?
An instant sell. I mean, it's going to be something that undermines my confidence in either the management culture or business model. So I can be wrong on all three, unfortunately. I can be wrong on the business model. If I think that the business isn't as resilient as I thought it was, then that would be a reason to sell. If I thought the management and culture is good, but it turns out not to be. I mean, if I had any doubts about the integrity of management, and we've seen obviously this happen quite a lot, where a company comes out and says, "Well, our management have been not behaving in the right way." If I think that they're not treating employees very well or suppliers, I want a business that treats all its stakeholders well, because ultimately that's the way to be sustainable, where everyone wins. I don't like businesses where someone loses badly, because I don't think, there's a lot written about ESG. And to my mind, the least sustainable businesses are the ones where one of those stakeholder groups is losing out. So if I had reason to think that, then that would be definitely a reason to reappraise. It's exceptionally difficult to do, to change your mind on a business. It's very easy to overlook the warning signs, and it's something that I'm definitely not immune from. But you just have to, again, the reason why the checklist is there is because you're saying, well, do I still think that? And if you don't, you do need to be willing to change your mind.
Thank you. Now, Charlie, with regards to your checklist and monitoring your companies, which I know you'd be doing intensely regarding your portfolio, will you be visiting the companies, the firms, speaking with the CEOs, CFOs, and attending AGMs, etc.?
In some cases, yeah. So it really depends. You look at a business like a Microsoft, for example. That I've never met Satya Nadella, and may never meet him. But for a business like that, there's so much information available online. They do conferences, which they release online. You could spend all day reading through information. So and there's so much written about the CEO. So all the information I need is there. I don't necessarily need to meet with him. On the other hand, a diploma, which is a smaller business and less in the public eye, and there's less written about it. That's a business where, well, I did recently meet their CEO. I recently had a call with their CEO, Johnny Thompson, a Zoom call, to discuss mainly the culture of the business. But so it really depends. But yeah, some businesses I will meet management, I will attend conferences, etc., and some I may not. I don't really have a hard and fast rule. I just need to make sure that I can understand it. Sometimes meeting management can be a double-edged sword. I think you have to really do your work on a business, do your research on a business before you meet management. If you meet management, then it comes back to what I'm saying before. If you meet management right at the start of your research process, you can buy into a story and a narrative, and then it's very hard to get out of that frame of mind when you're reading the balance sheet or something and seeing, oh, I don't quite like that, but I've been sold a story. You have to be a bit careful.
That's so true. Very, very true. Now, Charlie, given your high conviction Wealth Club quality share portfolio, in comparison to other funds in that sort of niche. How's yours going to differ?
I think there's probably a few ways. I think and this isn't exclusive to me, but I think the long-term approach of always viewing business, having an ownership lens around a business rather than I own a share of a business. I pretend I own the whole business and I treat myself as a business owner, and then I look to own that business for 5, 10 plus years. That approach isn't common with other fund managers. There are some notable exceptions. But it isn't common, I think, because short-termism does prevail in the industry, unfortunately. And I've seen that on both sides of the fence. I saw that obviously a lot when I studied fund managers previous in my career. So having that long-term view, ownership, business ownership mentality, the number of stocks that I'm owning, 15 to 20, normally you'll often see 50 to 100 companies within a fund. To my mind, that's far too many to keep track of. You can't possibly have as much conviction in your 50th or 100th idea as you do in your first. So that's a key difference. And then, as I was saying earlier, the culture, being so focused on culture and management is not something that I see as common in the rest of the industry. You know, you can't boil culture down to a number on a spreadsheet. And I think a lot of investors and fund managers, they like to be able to have things in spreadsheets. They like to be able to model earnings over the next year or two. I don't do that. I'm much more interested in the employee reviews of a business than I am an analyst report, because the employee reviews actually give me some insight into the business itself rather than an analyst who's written about what the next quarter's earnings will be. So it's a very different approach. And then for people who do invest in my portfolio, I provide a lot of information. So most funds give you a fact sheet with top 10 holdings. I will, for investors in my portfolio, will see every single holding. I will write at least once a month explaining portfolio developments and what's going on, my thought processes, etc.
Thank you for that. Now, how does one become an investor in your share portfolio, and what are the charges, Charlie?
So the portfolio is available exclusively through Wealth Club. It's not on any other platform. So you just need to go to our website, and there's loads of information there with a video. If you haven't had enough of me by now, but there's another video you can watch, and lots of information on there about the portfolio. The charge is a 1% annual management charge. There's a 0.25% custody or platform charge as well.
Thank you for that. Now, Charlie, investors often want to know that the performance of their investment is aligned with that of the individuals leading and managing the fund they're invested in. Have you and Alex Davies, the founder of Wealth Club, invested some of your personal wealth into the portfolio and the management of Wealth Club? And could you share?
Yes. So I myself and my wife have a six-figure sum invested in the portfolio, which is a substantial part of our wealth. Alex Davies has also invested a substantial part of his wealth in the portfolio and intends to invest more as time goes on. And as have many other staff members at Wealth Club, actually. So no pressure. But yeah, I mean, the reason, one of the reasons for setting up this portfolio was to provide a vehicle for staff, employees at Wealth Club to invest into, as well as clients. So it's very much and I couldn't agree more, that alignment is essential between the manager and clients. So I get the same companies that clients do, and I'm very have every incentive to make it work.
Brilliant, thank you. Charlie, you spoke earlier about the importance of management and culture within companies. Please can you share how Alex Davies, the founder of Wealth Club, not only recognized your potential as a graduate in 2011, but is now building a new investment culture around and with you now in 2023, with the leadership culture being nurtured at Wealth Club?
I think Alex Davies has always been very good at hiring good people and just letting them get on with it. So you get a lot of, and this has always been the case, even when I work with him at Hargreaves Lansdown, you get a lot of autonomy and a lot of responsibility. And I think that is very much the culture that's created at Wealth Club. It's very entrepreneurial. People are given a lot of autonomy and responsibility, and I think that's a very good way to motivate people. I think too many businesses, especially as they grow bigger, they become very bureaucratic, and they start putting barriers in the way of people to do their jobs, and actually doing the job, the day job becomes less and less important. It becomes harder to do, and many businesses operate like that. But Wealth Club is very much the opposite. It's very much everyone rolls their sleeves up, and everyone just gets on with the job at hand and has the tools and responsibility to do so. Yeah, it's really, to summarize, it's probably just an entrepreneurial culture is the best way to describe it. And that is something that I look for in businesses that I invest in, is that entrepreneurial culture. Because if you're very bureaucratic and full of process, policy and procedure, it's a great way to lose relevance. And you see it time and again with businesses as they grow larger. They stop innovating, they become complacent, they start hiring loads and loads of people, and actually become less and less efficient. Because the more people you hire, the more the responsibility dilutes across a business, and that's not what you want. You want to employ a person and say, this is your responsibility. If you do it well, you'll be rewarded, and if you don't, then we'll know where to come if things go wrong. So to my mind, that's the best way to run a business, and that's how Wealth Club operates.
I agree with you entirely. Thank you for that reply. Now, Charlie, I've asked you all the questions that I had prepared. Is there anything you wanted to add regarding this interview that we've had today?
No, I think we've covered a lot of ground. I suppose we could draw out some general lessons for investors as a whole.
Yeah, please do.
Well, I mean, I think individual investors are in a in a in a different position, in a privileged position in some way, to be able to take a longer term view. We talked about, you know, fund managers and professional investors often being very short term. I think if individual investors can take that long term view, 5-10 years, then they may not have access to all the resources necessarily that a fund manager has, but they're playing a different game, and the odds are stacked in their favour as long as you do your research. But if you have that it's a behavioural edge, really, that I think private investors in particular are very well suited to capture. Having patience, not trying to get rich quickly, try to get rich slowly. Let compounding work for you by having that long-term perspective. Don't get wiped out, so diversify. Don't put all your eggs in one basket. And find those resilient businesses that can ride out the highs and lows to capture long-term compounding. Humility, it's the more I've gone through investing, the more I've realized how little I know. Don't try to forecast what's going to happen next. Don't try and predict the economy or what the stock market's going to do. Don't try and time markets. If you don't understand a business, move on. There's plenty more businesses out there. Just have that humility to understand what you do understand, what's it within your circle of competence. And probably don't outsource your thinking either. Don't rely on tips. Don't rely on, just because I've said about the businesses that I invest in, that's not a reason to invest yourself. It's maybe a reason to do more research, but ultimately you have to come to your own opinion. I think, because if something goes wrong, you need to know why, and you need to know why you invested in the first place. So I think for shrewd private investors, there's no reason why they can't do just as well, if not better, than professionals if they play to their strengths. And as I mentioned, the management and culture side of things, ignore it at your peril, I would say. It's something, again, that most professionals, I don't think, pay enough attention to, but private investors are perhaps better placed to understand. And if they do have that long-term perspective, then they can really benefit from those businesses with great cultures.
Charlie, that was an absolutely fantastic synopsis of what our conversation, and thank you for sharing those highlights and insights for our global listeners, which are some fund managers as well, private, ultra high net worth individuals, all listen to this Investing Matters podcast. Thank you ever so much. That was Charlie Huggins, Head of Equities and Manager of the Wealth Club Quality Shares Portfolio. Charlie, it's been a delight speaking with you today on the Investing Matters podcast. Take care. God bless you.
Been a pleasure. Thanks, Peter.
Thank you for taking the time to listen to Investing Matters. Be sure to check out the London South East website for free tools and info to research your next investment. You can also join in the conversation on our social media channels. And don't forget to subscribe to our YouTube channel for more content, including our CEO interviews. Catch you next time.